Hey guys, what up? It's January 3rd, and we're going to go over my take on Honest Company, the stock, business, future expectations, why I like this business, why I own the stock. So I want to give you guys the breakdown on Honest Company, symbol HNST. All right, before we get started, of course, please hit that like button, hit subscribe. I really appreciate your support. Hopefully you take something from these videos, learn something, and let's have some fun in the meantime. All right, so let's get going. Okay, so let's start with what is Honest Company and what kind of business is it? So these guys describe themselves as a mission-driven lifestyle brand that formulates, designs, and sells clean products with a focus on sustainability and thoughtful design. In short, they're a retailer of baby and women's products, right? Simple as that. We have the baby line, guys. I'll show you here. We have diaper subscriptions, diapers, wipes. We also have lotions and balms for babies. Not the most exciting business in the world, but it is a steady business on the baby side. Then we have my favorite part of the business, which is the beauty, bath and body sort of skincare and makeup line for women. This is the part of the business that is exciting for me, and it's definitely my favorite side of the business. We also have the cleaning side, which is home sanitizing, hand sanitizers, cleaners, and all things for the home that have a natural sort of healthy sort of origin to these products. All right. Now, when it comes to the cleaning side, I don't see these guys taking over, kind of like your Clorox products and those kind of chemically products you see at the store. I come from a Hispanic family. They could care less about how clean a Clorox wipe is or how healthy it is for a baby or a child or a dog. So I don't see these guys kind of competing with these guys, but they are in a very kind of niche segment of moms that sort of do the extra research and have that extra level of care that the products are kind of conscious for their family members. All right. So of course there is some bouginess to this business, but I've been proven wrong before in businesses that are proven to be for sort of higher echelon sort of buyers, higher income buyers like Honest Company, which I do feel it is a business for that higher income bracket. But I've been proven wrong before because I love businesses that cater to women. And I'm talking about my experience with Revolve. Let me show you guys Revolve real quick. So if you can see here, very similar sort of look to Revolve. This is clothing, dresses, shoes, beauty stuff for women. The average ticket price or the average spend of a person on Revolve, which is, I'm going to assume it's mostly women, is about $300 to $400 a ticket. And these clothes are expensive. They are not cheap. And this is what drives my liking into Honest Company. I feel that it serves the same kind of customer that Revolve does. And here we have a little bit of a chart here for Revolve. The chart is any indication of what this kind of business can do as far as share appreciation. I mean, we're looking at a 52-week range of 31 to 89. I was buying this back when it was in the low teens, guys, and I thought this business is just too expensive. The clothes are too expensive. All my coworkers said, this just seems too expensive for me. And boy, was I wrong to think that way. And I think these businesses can make a ton of money. This is why I also like Honest Company, because I think it serves the same type of customer base, essentially. Now, moving on, all these products for Honest Company are going to be sold through retail chains, and they're going to be sold online. The retail chains are going to be Target, Walgreens, and Walmart. And also, they're going to have their Amazon side and their website here for direct-to-consumer, in which they have diaper subscriptions and also some makeup subscriptions, for people to get their products there. So, it's as far as the spread in those two channels, we go to the latest conference, the latest quarterly report that shows us the digital side, how much money is making, and the retail side. And we see here, very interesting, that in 2020, we see that digital takes the cake for the most money brought to the business. But of course, this switches in 2021, and now retail takes the cake as more reopenings happen. So that's the spread of how the business is selling at this point. So pretty simple with the overall business. Let's move on to the stock. This is usually everybody's favorite part. What do I think about the stock? So we see on the max price action here, it became public on May 5th, high of $23.88. I believe they became public at about $22 a share, currently trading at $8.25. So this is a stock here. We see it on a 1 month chart. It's been bought pretty heavily in this range of $7.40 to $8 a share. And there's a lot of bottom feeders here, meaning a lot of bargain hunters looking at the stock and saying, hey, we may be looking at a bargain here. So the stock on its metrics, trades at a valuation of about 750 over here, $724 million market cap, and a price to sales ratio of over 2.25 price to sales ratio. There's no price to earnings metrics because it is not a profitable business. We'll go over that in a second. But you don't see those metrics when a business is not profitable because there are no earnings to compute here. All right. Now, another note we have to do is that the lockup expiration for the stock has already come and gone, guys. So the insiders, usually when these companies IPO or they list via SPAC, they have a certain time in which insiders cannot sell their shares. It's called a lockup expiration. It's usually maybe about 3 to 4 months after the IPO, but it varies stock to stock. This has already come and gone, so insiders can already sell shares, and those that wanted to sell options did a lot in December. So we've already gotten the hit from insider lockup. So I don't think that'll be a problem in the future. If they still believe in the business, maybe they'll sell some options, but as far as acquiring shares, we did see some insiders acquire shares in December, just straightforward acquisitions of shares, which are just straight up buys, which cannot be interpreted as anything else than faith in the business, which is a positive. So let's move on to the fundamentals of the business. And I want to take you guys here to the balance sheet. All right. The balance sheet shows us a asset side, of course, the asset side right here showing us cash and cash equivalents and short-term investments. That's what we're going to count towards the asset side. That's probably about $90 million of cash and cash equivalents and STI short-term investments. Now we move on to the liability side, which is right over here. I'll highlight it here for you guys. Total liabilities. We're looking for long-term or short-term debt in these items here. We see here the only thing we have is about other long-term liabilities highlighted here. The only thing is accounts payable. We're not going to count that. Everybody has accounts payable. Accrued expenses, not that big. Deferred revenue, not that big either. I'm going to count lease and other long-term liabilities, which means they still have a ton of cash to operate this business and a ton of flexibility. That's an A-grade balance sheet in my book. So fundamentally strong on a balance sheet basis. Now moving on to the income statement. All right, we have here the revenue. This is the top line revenue. Not a lot of growth on a year-over-year basis, on the third quarter basis, also on a 9-month ended basis. Not a lot of growth there. But if we listen to the latest conference call, we're going to see that the issues are outlined right here in the operating expenses for the business. So this is a business that's seen some headwinds because of inflation, because of freight, because of warehouse, labor cost. And they're all outlined here. We're seeing selling, general, and administrative costs increase on a 9-month period. Very, very much. That's a really wild increase to the upside. Marketing, they're spending more money there. And they're almost doubling their research and development spend, which is not necessarily a bad thing. I like companies that do spend on research and development because that keeps the pace of innovation, the pace of new products going. That's important to a business. But at the end of the day, we see this as a unprofitable business running a net loss on a quarterly basis of $5 million on Q3 2021, equating to 6 cents loss per share. On a 9-month basis, 33 cents loss per share. But at the same time, these guys are not far away from profitability. I think they're maybe a year or two away from profitability here. So not all bad news here on the income statement. All right, so let's move on from that. We know the business, we know the fundamentals are good. Now, why are we positive? Why am I positive on this business? All right. But actually, before I do that, let me show you my position on the stock, because I want to make sure that I don't leave that behind. All right. So here's my position on Honest Company. Right now, 660 shares for the account. We're down 16% on the position. Current share price, like we saw before, $8.24 per share. So here's, everybody would say, oh my God, you've lost $1,000 in the stock. Haven't lost it because I haven't sold a dime. I haven't sold a single share of the stock. I could care less about the short-term action of the stock. Any action to the downside under $12 a share is a gift, and I'm taking it. Any chump change that I have, maybe I skip a lunch and I throw my lunch money into Honest Company. No problem doing this. I actually don't own only 660 shares. I owe about maybe 800 shares over two different accounts. This account and another account, which is my 401k. So I'm totally fine owning up to 15 to 2,000 shares for, in between those two accounts. So not done buying it, very patiently taking my window of opportunity and picking my buy spots when these dips present themselves on the stock under $8 a share. So back to why am I positive? So we'll start with, I love businesses that cater to women. We talked about Revolve. Okay, this is a business that catered only to women. They did have some guy stuff on the side, but that stuff doesn't sell. Let's be honest. Guys don't go online and shop Revolve or shop stuff like that. We just don't do that. But businesses that cater to women, and I equate it to this. People say often, and I hear this on the news often, that small business is the engine that powers America. And my addition to that would be that women are the gasoline that powers that small business. Because women are shoppers, way more shoppers than men, in my opinion. Of course, correct me if I'm wrong. Hit me in the comments or send me a punch in the comments if that sounds insensitive. But I do believe that women-owned businesses are very attractive to investors, myself included. All right. Now, the second point is effective and cheap advertisement through social media. And they have the cash to do this. Let me show you guys. And here's what I'm talking about. We have YouTube here. You just put Honest Beauty. I put foundation, which is what they sell. And I was looking through different products. You have here 2,000 views, 69,000 views, 481,000 views, 11,000, 121,000. I mean, look at these views here and all this advertising channel for Honest Beauty. Makeup tutorials are a thing. Everybody knows that, or everybody who kind of has the internet should know that already. And this is as close to free advertisement as you get. I'm sure that Honest Company is paying these ladies, as well as they should, for their time and their effort and the effort into editing videos, because I hate editing. So good for them. I hope they're making money. But this is a great form of advertising. This is the future of advertising, really, in my opinion. So great job by Honest Company doing that there. Now to my third point. Okay, we have over 40,000 retail locations driven by skin and personal care products and growing. Okay, we have an addition of skincare items, roughly 3,000 Walgreens stores with health and wellness focus. So Walgreens has a big initiative and some big changes, Walgreens and CVS, into health hubs. And I think that Honest Company is a good product to have to assist Walgreens and maybe even CVS in the future in putting that health hub image. We also have continued expansion into another 385 Target stores in Q1 of 2021. We're already in Q1 2021, so can't wait for that expansion. My local Target store is a smaller store. It doesn't carry Honest makeup yet, but they do have the skincare products, the diaper and wipe line, and I'm constantly looking at those to see, kind of doing channel checks to see how those are moving, and those move pretty well. So pretty happy with that Target sort of retail line there. Now moving on, 40% of all Honest.com, that's the direct-to-consumer channel, have come through for skin and personal care. Again, my favorite segment of the business, and I think the one that has the best growth path moving forward. Skin and personal care, 40% of new clients coming through there. Then, of course, diapers. Yeah, diapers are a growth segment. So I was reading about the diaper industry, and that it usually grows at about a 14% rate year over year. And I'm talking about the actual overall industry. But diapers and wipes from Honest Company are growing at a 20%. They're outpacing that general growth rate of the actual industry for now, right? I don't know about like birth cycles and when people have babies versus when they don't. But essentially, it means they're cutting into somebody else's business, which is good. That's disruption. That's what we want to see, all right? We're also watching out here, very important, for price increases in Q1 2021. And I just ruined it, whatever. So in Q1 2021, to offset the higher cost of business that we saw on the income statement, we have to watch those price increases moving on. Because if we see no longer a 20% growth, or we see maybe a growth rate falling under that industry growth rate for diapers of 14%, then we're in some trouble. So we have to watch out for that. And at the end, skin and personal care has grown 28% year over year, driven by retail stores, which is positive. And then the opportunity in household items through more promotions, maybe. That's the cleaning stuff. That's like your cleaners to clean your counters and your glass cleaners and hand sanitizers. Again, not too excited about the business, but I think that they're going to do something else with that. They'll have an opportunity to do it. They have the cash to do it. So we'll see. Maybe. I wouldn't be mad if they actually sell that part of the business, to be honest. No pun intended. But if they do, they make some cash from that. So totally fine with that. So overall, guys, that's my breakdown of Honest Company. I like the business. I like the skincare and makeup line of the business. And I think that has huge growth capabilities in the future. I'll be holding the stock for a while, at least another year. I'm looking at Q4 2022, maybe even Q1 of 2023 to really start seeing some results in this stock. But in the meantime, be patient. Take buying opportunities when they come. If you feel like you want to pull the trigger, of course, all these investment decisions should be yours. You shouldn't make them because I'm making them or some other YouTuber or CNBC or whoever's telling you. Do your own research, make your own decisions, suffer the consequences to the upside or the downside. All right, guys? Peace out. Have a good one.